Yeah. Thank you, George. But what I plan today, what I plan to do today is to just give a short presentation and leave most of the time to question and answers. And in the other presentations that I gave, I normally would ask the students a couple of questions, and I'm going to do the same thing here. And so I'll start with a question. When you go shopping, do you all look for bargains? Please raise your hand. Those who and when you do buy bargains, do you think that is a good buy? Does it make good financial sense? So, okay. So you can see, George, in this class, the students have the mental makeup of being a good investor. So what do we do in value investing? We just transfer the way of looking at life, buying bargains, and transfer it to the stock market. And it is not that difficult. If you can do that in your daily life, and you can transfer it to the stock market, more or less, you're 90% assured that you can be a good investor. So only thing that you need after that is be good in accounting, because accounting is the language of business. And once you can do that, then it's, you have covered your bases. In the last couple of presentations when I came here, I gave, let's say, what do you look for? Let's say, the first one was, what do you look for in a good company? That was in the first presentation I gave. And last year, when I came here, I gave a presentation on net working capital companies. What do you look for in net working capital companies? And so today, normally I try and take examples, not something that I've done in the past and show you how well it has worked, but something that is current, something like what are you looking for right now? What are you finding in the market right now? And right now, what we are finding, let's say in one sector, in pharmaceuticals, we are finding bargains in that sector. So I just want to show you one ratio, one way of looking at it, and just to show you that it is cheap. This is not the only ratio that you should take. There are other ways of looking at it, but this is one way of doing it. So I'm just going to put it on the screen here. So as you know, in pharmaceutical companies, the good points are, they are in aggregate, they're good quality companies. They generate high returns on invested capital. And we know going down the future, they have really favorable demographic trends. And they have operating efficiencies that, that they can really improve on. And they have strong balance sheets and they are really great cash flow generators. So those are the good points. Something that, this industry has these great numbers. The negative side to pharmaceutical companies are pipelines. Like, how do you evaluate pipelines? And that is where you get into trouble, because in pharmaceutical companies, you don't know what your competitors are going to bring in 3 to 5 years down the road. You don't know what drugs will be blockbusters. So to mitigate that risk, what we do is we buy a basket, and so we go to the next chart. And so what you can see is, I'm just looking at, this is a basket. There are other companies there, but for the sake of simplicity, I just took these 6 or 7 companies. At this time, if you look at 2008 numbers, they are around 6 to 8 times, 6 to, let's say, 15 times earnings. But the key thing to look for is, let's say 3 years down the road, what will they look like? What will the balance sheet look like? So we're just concentrating on balance sheet strength and then netting out the cash and the dividends that they have paid. So we go down to the next page. So you can see what we did on this one is whatever dividends that they paid, we added back to cash. The reason for doing that is that some companies pay dividends, some don't. But And to be able to compare apples to apples, I just added back dividends that they have paid back to cash. And so that everything is compared apples to apples. So you can see 2011 numbers, go to 2011 numbers, look at the PE ratios. Let's say King is trading at 5.4 times earnings. This is after netting out cash and dividends. And then you can see Pfizer is around 4.3, and Bristol Myers is around 6 times earnings, and same thing with Merck. And so as a basket, if you buy them, then you don't have to think about the pipeline problems. Another way of looking at pharmaceutical companies is like if you take an analogy with sports. Let's say in hockey, these companies right now are trading as if let's say in hockey, let's say they just have 4th round draft picks, but these companies are actually closer to 1st round draft picks. We know the superstars are aging; they're about to go, but we don't know the draft choices that will come up next 2, 3 years, 4 years, and you know something good will happen. You know, as you know, if you follow hockey or any sports games, draft picks will come in, new players will come in, and they will substitute the ones that are superstars, and so that is what we are counting on.
Francis, how do you get these projected 2011 net cash and equivalents per share? How do you get
we just did a projections, and we looked at several projections of what the earning power would be over the next 3 years. And because of pharmaceutical companies, they are kind of stable cash flow generators. The chances of making that type of projection of making an error on those projections is really low. So you have high confidence that the cash flow that they're going to generate the next 2-3 years would be there. But if you take another industry, let's say high tech or commodities, then it's a big question mark. So we're just saying these are the earnings they're going to make, and most of the earnings are in cash, and it's the net of R&D, and so we just came up with those numbers. Yes.
I was just curious, as part of value investing, you typically don't project future earnings and future growth in cash flows. So is this still in line with traditional value investing?
No, but the question that you're putting is a really good question, and therefore the industry that you're picking is critical. So you're picking like companies like pharmaceutical are somewhat slower growth, but the cash flows are more or less predictable. So you're going into an industry where you can.
So what kind of growth rates do you put in there, or you just take what they have now and just repeat it?
Yeah, what they have now, and kind of repeat it.
Yeah, so more or less stable, I guess.
Yeah, and what they have done over the last 2-3 years, and then we try and see what management is saying, what they can make. But that's a really good question. When you're in value investing, you're looking at normally in the past what they have done in the past, but you have to have some sense of what they're going to do in the future, some sense, and so we just took that and put it there. So you can see based on this, and since we're not targeting one company, we are buying a basket of let's say 4 to 6 companies or 4 to 8 companies. All that question that you have on pipeline is kind of reduced, and the worry is also is mitigated. So okay, so we go to the next one, and so you can see not only on earnings it is cheap, but the other criteria which is so critical is called free cash flow. And so the free cash flow numbers and the earnings and the PE ratio is roughly the same. And free cash flow, by the way, in many ways are far more important than price to earnings ratio, because earnings could be manipulated, but free cash flow is kind of more harder to manipulate. And so if you buy a basket, this has been my experience. If the industry is cheap and they have stable cash flow generators, if you buy the basket, it normally works out quite well over the next 5-year period. Okay. And this one, normally, this is not a ratio, but it's also an important ratio to take, is just take the R&D spending, research and development spending, and you can see these guys are spending quite a lot of money. If you look at Pfizer, they're spending like $38 billion over the next 3 years. The market cap is around 120 billion. And same thing, let's say Merck, 24 billion, their market cap is about 80 billion. So you know something positive will happen when you're spending that kind of money. What makes pharmaceuticals sometimes hard to invest is that you know the negatives right now. You know these drugs are going to expire in the next 2, 3, 4 years. But you cannot project what the next blockbuster would be. And no one could project that. And so when you play the basket, you eliminate that kind of a problem. So with that, I'll open the session up to question and answers.
So back to the question of your growth projection,
Right.
of your cash flows. As you stated, one of the problems is the pipeline,
Yes.
in the drug pipeline. How do you incorporate a probability that the new patents, the new R&D that we're developing patents, replace equal or greater number of expiring patents
Right.
in these companies, therefore maintaining your growth projection?
Right. But what you're asking is a really good question. So that's the reason why you are playing the basket. If you're going with individual companies, then you can say, well, let's say like with Lipitor is about to expire, and that's 20% of the revenues and 20% of the profits. You need something blockbuster to replace Lipitor. But when you're buying a basket, you kind of somewhat eliminate that question. Yes. Okay, I'll go from my right. Yes.
So in this case, you're starting by assuming that the pharmaceutical sector has been beaten down.
Yeah, they are really beaten down, and this is the time when you can invest in them.
Right. So what leads you to that conclusion that it's been really beaten down right now, and that things will change going forward? Because that's the fundamental kind of assumption, right, on which.
Yes. But pharmaceutical normally, they are, by the way, if you look at their free cash flow generators, they are great cash flow generators, and they have good return on equity, and all those statistics that you need to look at for a good company or a good industry. And as you know, if you look at the history over the last 30, 40 years, drugs will always expire. There are always drugs expiring, but there are new drugs also replacing. And that's what you're counting on. But you don't know which companies would have the blockbusters. You don't know which one. So you play the group. You play the basket. And so that is one way to resolve the problem. But not on one individual stock. I don't know what Pfizer will do or what Merck will do. But since I'm buying, let's say, a basket of 6 stocks, it eliminates the problem. So, okay.
So why isn't that already the case? Because what you're saying is that there's a continuity, right, in which there will be some blockbuster at some point in one of these companies.
Yes, there will be, because they're spending so much money, like $38 billion, right? Yeah. Like, for example, in the case of Pfizer, they're spending $38 billion. There will be something coming down the pipeline.
So what I'm saying is that where's the additional value going to come? Because it should already be in that basket. Because in the past, somebody looked at the basket and said, there's going to be a blockbuster, right?
Yeah.
So wouldn't that already be reflected in that basket? You see my question? Or?
Yeah, but at the price that they're trading at, they're already trading as if, let's say, in these pharmaceuticals, those drugs, those superstar drugs, as if they're going to expire. It's already trading at that price. It's discounted the problem. So yeah, but if you look at Pfizer, right now it's trading, let's say around $19. But it was trading at $40. Then it's different. It's like you have Gretzky on your team, but at the price they're trading at, it's as if Gretzky would be out of the team the next year. But if they're trading as if Gretzky is going to play for their team for the next 10 years, then it's a different story. The price already reflects those drugs are going to expire. Okay.
You mentioned you look at strong balance sheets.
Right.
So what are some of the key aspects in the balance sheet that you would look at? So would it just be the financial leverage that they have, or are there other factors that you
balance sheet, if you're a value investor, that's one of the first things you concentrate on. So you're looking at off-balance sheet liabilities. You're looking at let's say if they have cash flow problems, in the sense of are they losing lots of money, like red ink, And those things you have to look at. So it's not just the balance sheet right now, but kind of balance sheet what it will look like a couple of years down the road.
So once you pick the basket of these pharmaceutical stocks, do you further qualify them, like these are the people that are working on, these are the companies that are maybe working on geriatric drugs or something like that, because you know that those companies will be more favored in their blockbusters because of the fact that most of the developed world's population is growing older, or is it just that we were looking for locally?
I'm looking for a financial bargain, but the question you're asking is a good question. So I take a broad approach. Out of these companies, you can expect, let's say, out of 5 companies that you pick, I expect at least 1 not to do well. I'm just playing by ratios. So one won't work out, but the other ones will compensate, and that's what you're counting on.
So do you assign a different weighting to each company you're about to then? Or?
Normally, weighting is tough. Sometimes you cannot give it a straight, kind of a straight answer, because what happens is if Pfizer, let's say, instead of trading at 19, now trades at $9. Then what you do is then you weigh more. So price plays a big role in your weighting, plus the quality of the company. So, yeah.
In terms of you talked about management, so it's very important to look at the management. And for people who are starting out in this industry and they don't have knowledge, in-depth knowledge of how the industry works and all that, how can we find credible sources? Because I mean, you look at all the annual reports, you look at different interviews, they never really reveal the true, characteristic of management. So what kind of credible sources did you go to, or what process did you go through?
I'll take it more as a generic question, is like how do you assess management? Normally you have to look over, let's say over a 10-year period. And then from a perspective of a value investor, you're looking at, the key thing is allocation of capital. Do they waste money? How do they allocate capital? How did they allocate capital over those 10-year period? And in a 1-year period, you cannot tell. But over a 10-year period, you can make a good assessment. Have they wasted money? And then you can look at margins in terms of current operations. How good are the margins? If the margins are really low, that means it's not run lean and tight. And so there are many factors that you can look at it. But numbers do tell a story. And you go with the numbers first, and then assess management on a qualitative basis. So.
I was just wondering whether you look at R&D, like a multiple of R&D to cash flow. That relative figure would sort of give you a better idea of whether it's replacement investment as well as new investment.
Yeah, that's a really good question. When you're looking at companies that are great free cash flow generators, you're also looking at something called looking into the future. Like, are they just milking the cash and not building the business? And in this case, if you look at the R&D as a percentage of their revenues, it's fairly high. So they're doing all they can. They're spending the money to grow the business, but at this time, they haven't seen the results. But eventually, when you spend that kind of money, something positive will happen.
So I know this is kind of asking about the future a little bit, but you mentioned that within a lot of those stock prices that the expiration dates on certain drugs has already been priced in.
It's already been priced in, yes.
And so you've got a lot of spending on R&D, and you're expecting a certain number of blockbusters to come out of that, and then ultimately, I guess, lift the sector back up, and then you can extract value from it. So how long do you plan on holding this basket of stocks, and how long, I guess, do you expect it to take until that gets priced back in?
At least 5 years, until something happens. And when you buy them cheap, something that has been my experience, and also with other value investors, something positive will happen. There will be a catalyst. Let's say in the case of King, there are rumors a week ago that Pfizer was thinking of buying them out at some price. And there's a rumor, let's say, on Watson right now that some big hedge fund investors have taken a big stake. They're thinking of doing something with the company. And that's the big plus of buying cheap. So, yeah.
In this course, we have learned that, we have to find the right stock and concentrate rather than diversify. But this concept appears to be like you are diversifying among different stocks. It appears a bit counterintuitive to me.
But you're asking in terms of when to concentrate and when to diversify? And that's a really good question. In this industry, in pharmaceutical, it's very hard to concentrate because you don't know what drugs will be competing against each other 3 to 5 years down the road. You don't know which ones will be blockbusters. So the only way to play it is to play the basket. But normally you do concentrate if your knowledge, your competence of a company is high, and that's what Buffett does. He really knows the company and knows the industry, and and it's selling at a cheap price. That's the time to concentrate. Sometimes, when in investing, and that's a judgment call. You do rifle shooting, one stock at a time, and you concentrate. And there are other times where that certainty is not that high, and that's when you diversify. And so both ways, you can play the investment game as a value investor both ways. There are guys who concentrate, like Buffett, let's say Irwin Michael kind of concentrate. And then there are other guys who have got equally good results, like Peter Kundal, Brandes. They diversify. Both are good ways to invest. And it depends on your temperament, depends on your makeup. Yes?
Now, how do you ensure margin of safety? Because it sounds like you're taking risk on certain companies performing well due to pipelines, or new drugs that come down the pipeline, certain not performing well because of patents expiring. So in this, you're kind of looking for, it's almost like it is a portfolio. But how do you ensure margin of safety for your invested capital?
No, this margin of safety comes in because of the price. It has been beaten down so much.
Okay, so by looking at the price, how can you determine if the margin of safety is 30%, 40%?
You can do it, let's say, discounted free cash flow returns. You take your discount rate and discount it. Then you also have, it from, let's say, from history, roughly what they have sold at on average. And then you use another yardstick that we normally use. These companies, if they are sold, what they are bought for, let's say in the past, let's say last 20 years, in the last 5 years, or the last year. So you can kind of keep a list of when they are bought and what price they're bought and sold.
The second question is, these are all large caps in the pharmaceutical industry. Would it be too risky to look at mid caps or even to smaller caps for pharmaceutical?
Smaller caps in the pharmaceutical is kind of more risky. You have to know more about it because they are dependent on one drug being successful. Here, as you know, one drug does not make a big difference.
So would you buy an ETF or just you put together your own basket?
You can when they are cheap, you can buy the ETF, and that's a good way to play also. And you can also not only in this in the drug sector, but in other sectors. If you think they are cheap, you can buy the ETF.
Many of these stocks, let's look at the stocks. Many of these stocks have been going down for the last 2 or 3 years,
Yes.
And so how do you avoid the value trap here? Because you have said the same argument, I guess, a year ago, and you bought it and the stock kept going down.
Right.
Like, what do you do in this case? Like you double up, or if you bought it last year and it keeps going down, you stick with the story, I guess, or you?
Most probably, what happens sometimes when you're in value investing, you tend to buy too early. But if your thesis is right and you're fairly confident about it, then you should buy more of it. But there's also a point where if you made a mistake, then you just have to admit it and then move on. The danger is sometimes when it drops a little bit. Sometimes value guys may buy, but the question you have to ask is, at this price, has it discounted all this future patent expiration problem? If it has discounted, then you know you have come close to the bargain price that you want. So the question is, the question that we all ask is, has it discounted that problem? And so at the price we are looking at least 4 or 5 of the stocks here, we think it has discounted all future problems. So we are not only in pharmaceuticals, but also in other industries, we also ask that question. If the price is really cheap, is it cheap enough, or has it discounted the problems that people are thinking that they're going to have? So.
Would you take leverage to buy this portfolio? You?
No, leverage is kind of a double-edged sword, so I would kind of be careful. The returns are high enough that I don't think you need to leverage. The problem with leverage is that you have to be correct, within that year or 2 years. But sometimes these ones will take like 3 to 5 years to work itself out. So that's the problem with leverage. There's a factor. There's also a time factor involved, and another factor where doesn't you're not in control. Other people could be in control when you borrow money.
I just wanted to be clear. What is the catalyst that you're looking for, and what is the catalyst that you're looking at? Is it the blockbuster drug, or is it the consolidation of the industry?
No, well, we just know something will happen. Like if you look at it like a hockey team, like I think they're trading as if all the guys on the team are like fourth round draft picks. But like in sports, you have first round draft picks, second round draft picks. Something will happen when they're spending that kind of money. Now the key thing is that if they were not spending that much amount of money on R&D, then we have a problem. As long as they're spending money there, we know something will happen. Okay.
Yeah, how do you decide that you've made a mistake? Is it a time limit, or do you revalue constantly?
Sometimes, when you reassess economic conditions, reassess the company, and sometimes it's far worse than what it was at the time we bought it. So once you reassess it, it's a mistake, then you just get out. You have to admit it. I remember when I was younger, it was harder for me to admit. But when you're older, you just admit it and move on to the next stock.
So when you find a list of companies like this that you like, would you consider buying their debt as well? Or would you just stick to their equity? That's a really good question, whether you should buy the debt first versus buying the equities. In good companies like these ones in pharmaceuticals, normally the debt is not that high. But in other industries, in other companies, you always look at the debt first before you look at the equities. The debt is much safer to play. And in today's market, it is giving you returns similar to equities at the prices that they are trading at. So a lot of debts are trading at 70 cents on a dollar with a, let's say, 3-year maturity. And those are great buys. So I would go into those first.
So given the time horizon that typical pharmaceuticals work with, has anybody looked at, say, the R&D spend 5 years previous to the earnings per share now to kind of see how well those two are correlated? And if so, I'm wondering which one's kind of rank in the top end.
We have done work like that, and you can do it. But 5 year is too short a period. You have to take it, let's say, 10 to 15 year period because of the patents don't expire in 5 years. And at this time, if you take it, you may get the wrong impression because they're coming off strong drugs. Like Pfizer is coming off Lipitor and so many other drugs. So you have to be be careful. You don't take the best period. And, best period, for those blockbusters drug. But it's a good question to do it. Like I said, this is not the only ratio. I just did it for one class just to show how cheap it is. You should do, let's say, 5-6 other ratios, 5-6 other ways of looking at it, and if they all come to some kind of same kind of a decision, then you have a good buy. Okay.
So you're working off the premise that since they're spending so much money on R&D, they're bound to find a blockbuster drug. Has history shown that there have ever been top periods in time where companies have been plowing that much into R&D and they haven't discovered them, or has it always been steady blockbusters?
The industry has done well, but individual companies have faltered, and that's the reason for playing the basket.
So for the industry, there's always at least one company that's coming up
with something, yes. Yeah. And you buy them cheap enough, and you're already buying it at a price that's discounting all these problems. So there's much less to lose.
How frequently do you reassess your positions in these stocks, or is it different by different industries?
You try and reassess it every 6 months to a year, and you're bound to make mistakes. If you haven't made mistakes, then you haven't invested long enough. So we look at it like that. And to give you some comfort factor in terms of mistakes, like John Templeton, one of the greatest mutual fund investor, greatest mutual fund portfolio manager, his batting ratio, according to him, is 60%, so 6 out of 10. So you can take comfort factor to get the numbers that John Templeton got. He was right 6 out of 10. So.
Maybe just to switch kind of industries a little bit. Given the current market, are there any particular sectors that you're looking into right now, maybe like financials or others where you think there might be bargains?
Financials definitely looks cheap, but you do run into one problem called how do you quantify those risks? How do you quantify those numbers? And unless you're really close to the picture, close to those companies, it would be tough to invest. But there are other sectors where you can make, where it's easier to make a judgment call, like retailers. You can invest in that.
Housing?
Housing, again, housing is kind of a little bit too early, because right now, according to some ratio, the house prices are still too high. They need to bottom out. For example, let's say the rent, if you want to look at one ratio, rent to the price of a house, I think historically the ratio is over 5.5%, 5.8. Right now it's like 3.8. So if you go by that ratio, the house prices in the States still needs to drop by, let's say, 25-30%.
Now this is in the U.S., right?
In the U.S.
In Canada?
In Canada, we have, it's still high. So I would be kind of still be careful. But there are areas where they're beaten down, so you have to do more work. That's all I know in housing. But I think if you wait for another year and see how the housing plays itself out, it will give you greater certainty. So, yes.
My question is, a moment ago you talked about your temperament in terms of you acted a little bit differently when you were younger versus today. And along the lines of temperament, are there any female value investors? And is that play at all into the temperament of the whole area?
There are a lot of really great female investors. In Canada, Jenny Rhetoric, who runs the Sky, she's a good value investor.
Kim Shannon?
Kim Shannon for sure. And same thing in the States. And I don't see any reason why females won't be really great investors. They're really good shoppers, so that translates into a good value investors. So. Yeah.
What are the research methodology you use to arrive to these basket companies actually? Do you look only at the public data, or what kind of other research do you use?
Normally we just go with the public data, and there's enough information there to make a sound judgment. So, yeah.
So you mentioned that a lot of these drugs going off patent has already been priced into these stock prices. And I'm wondering if you've looked at generics to see if the same phenomenon has been priced into generics, and if you're potentially seeing any value there if it hasn't been, or kind of how companies like Apotex, for example, have been affected.
It depends. For example, Watson has a lot of generics, and it's a broad. Like a lot of these drug companies, they're not like they're diversified across the industry. So.
I guess the greatest problem with the pharmaceutical industry in general is that 90% of the patents are existing in companies that have 10% of the equity in the market, and those top 5 or 10 companies have 90% of the equity with 10% of the patents. And so you're going after these great, large, well-known, well-structured, good companies. but they have to go get those other ones because they have they have the patents, and that's not part of their R&D spend really, right? So, how are you considering that interaction out there as part of your strategy, for your value investing strategy?
I think what happens is, as you know, these bigger companies have great cash flows. You can always buy them too, those companies. It's like a free agent, so you can buy them too. But you do have a really good question, but here we are just looking at this basket, and I could have made a basket of, let's say, 20 or 30 companies, and that would have made it really cumbersome. And we could have gotten into like smaller pharma, and you can see that some of them are really cheap also. But that would be like another 10 pages of presentation.
So you're saying basically, why don't you buy a basket of all the other companies?
Well, yeah, because the play, I would say the play is on the smaller side, on these 90% of the smaller equity, because they have the early they have the early revenue or either no revenue or early revenue companies that their patents will be valued as they go forward, as they get through different phases. Increase in patent value. So, and they'll be eaten up by these theoretically eaten up by these companies, or partner with these companies to extract that value for that patent.
Right.
And so that value is on those ones, and these ones are going to overpay because of competitive behavior for those companies. Therefore, your value will be existing on those smaller plays. That's one theory, and that's more maybe that's a sort of investment bankers type of theory there.
You can play that game, but then the assumptions you're making is kind of different. So you're counting on those companies that they'll bring their drugs online, and so it's predicated on their success. So it's a different way of playing it. This is kind of discounted on patent expiration. So.
I had a question about how you got started in terms of you started an investment club at Bell, and that's how you initially started in value investing. Is that still doable today? And the reason I ask is around the legal issues of there's just so much more licensing and membership and all of those issues that are prevalent today. I was just curious about whether you see people being able to do what you're doing, perhaps even from this class, in the future.
It's a really good question. You're asking, can people do the same thing that I did? And I would definitely say yes. But you may need a little bit more money in terms of legal fees, in terms of audit fees, in terms of regulatory fees, and so on. But there's more information. There's more people that have succeeded, and you can kind of track them, how they have done, and you can follow them. And money is bigger. Let's say when I started in '81 in Bell Canada, I had just my fellow technicians, and he just gave me like $5,000 or $10,000, and that was like $1 million to me. And nowadays, $1 billion fund is considered small. So the negative side is you do have more fees to pay, more regulatory hurdles to cross, but the money is so much more bigger. So, and definitely it's doable. And then you have another big advantage, educated, and to come to this class, to be an MBA, your IQ is higher. Everyone's IQ is higher than average. And all those are pluses. Plus you're well-read. In the time that I started, there was no internet. So you had to physically go to the library and read stuff. And nowadays everything is on the internet. So you can see the pluses, huge pluses compared to the negative. Negative is just a little bit more costly.
By all accounts, you've been very successful value investor. What do you think is your competitive advantage? What do you make you so successful?
George, that's a really good question you're asking, but it's hard to answer, but I could answer it in a generic way. I would say that if you believe in the value principles, and you buy them cheap, just like you do in your day-to-day life, and you think it makes good business sense, just do that in the stock market, and you will be successful. The only difference in the stock market is that sometimes it plays on psychology, plays on your own psychology, on your fears, your greed. And sometimes when you buy a stock and it's cheap, it can go down cheaper.
But if you know what you're doing, and you know you're buying it cheap, and you have that courage to do what is right, regardless of what the crowd is doing, there's no reason why you should not be successful. And that's what I did. I just stuck to my guns. And you can see even now, most value investors have not had good returns. And this is a time to have discipline, to stick to what you know best. And eventually, logic will out, like they say.
Like, how do you think you develop this discipline and patience over time, or you thought you developed this from your young age, and you had some upbringing, I guess, that made you develop the skills early enough, and you were born with them, or you develop it through life?
I think you kind of develop it, and then it was reading. A lot of it is reading biographies, autobiographies, reading great investors, and you found a common thread going back, let's say, 1920s. Let's say I read about Bernard Baruch, all those great investors. And if you look over the last 50 years, or in my time when I started in 1981, when I look back over the last 60 years, all great investors were value investors. There were times when they did badly, let's say 2 or 3 year period. But over that 30, 40 year period, they were outstanding. And that gave you the courage, the comfort factor to do your own thing, and not be afraid. And that's the other thing that I think in this class may not be important. But when I was in Bell Canada, that was I needed that courage to say that I can compete, and the logic I have is solid. It makes common sense, and stick to it. And so that what worked for me. But I know that if during that period, if I had succumbed to pressures, succumbed to short-term results, I would not be successful.
Can you see any sort of, from your, if you go back in time and you look at your young age, when you were little, can you see any influences at the time that made you realize you had a skill that would help you with this style?
Yeah, I think when I was younger, like I was born in India, and in India, what happens is when you shop, you just don't go to like Walmart and just buy it. Everything that you buy in India, you haggle. And when you haggle, you have to know the price and at what price you can buy it at. And so I did a lot of that, and I just transferred. When I came to Canada, after I read about Buffett, Benjamin Graham, I transferred that skill over to the stock market, or that temperament, or mental makeup, how to look. What does it take to be a good investor? So I just transferred it. And so if you're a good shopper, anyone who's a good shopper should be a good investor. That's the way I look at it.
Now, what other ways you have? I mean, of course, anybody can make mistakes, but what kind of steps do you follow to minimize mistakes?
Investing, what kind of mistakes you make? Oh, there are so many of them, and so many misjudgments that you make. When I was younger, you make a different type of mistakes. When I was younger, I was somewhat more cocky. And then when I made a mistake, it was hard for me to admit. And so as you get older, you realize mistakes are part of life. You're going to make them. And then you also know and understand something called the batting ratio. Like you need to be right 6 times out of 10. You don't need to be perfect to be a good investor. It's just like in baseball. If your batting ratio is let's say 300, you are considered a pretty good batter. You don't have to be like 100%. When you're younger, you're not aware of those ratios, and so when you make a mistake, you tend to compound them, and then you don't want. It's harder to admit your mistakes, and like they say, about when you're digging a hole, how to stop it. The first thing you do is stop digging, and so that's what I learned. Okay.
So you've been a very successful value investor over a number of years. So what continues to motivate you over, going forward? what is it that drives you, that continues to motivate you, to?
See, that's a really good question that you have. The way to look at it is when I took up value investing when I was in Bell Canada, like, it wasn't something that I just it was just not a job. When I first read Benjamin Graham and other value investors, it was like it is my life, like it's my destiny. Something I really enjoyed. It came with my strength, came with my temperament, and so it's something that you really enjoy, something I really enjoy, and that's why I keep doing it. You cannot do it for long if you don't enjoy investing.
Now the economy is maybe or may not be a recession. How important is this for you?
Normally, a top-down approach, we don't put that much emphasis on it. The key is to buy good companies and to buy them at a really cheap price. And if you can do that, you will do quite well.
Do you invest in only on companies listed on Canada and the New York Stock Exchange or other countries?
Now I invest worldwide. I have 5 funds, and the mandates are different. I have an Asia fund, I have a Europe fund, and then I have a bond fund, which basically invests in high yield. But the 2 longest funds I have they are Chou Associates, which is more U.S. stocks. Then I have Chou RSP fund, which invests in Canada. So I'm worldwide now.
Okay. Next question is, how many companies you personally evaluate in a day? Like, you would go through, let's say.
You're asking like how many stocks I look at? I would say in a more generic kind of answer, I would say you have to read about 100 to 200 pages per day. So you have to read quite a lot. And you can get ideas many different ways. You get ideas through screens. You get ideas from looking at what other great investors are looking at. And you get ideas just by reading. And so you have to read a lot, about 100 to 200 pages per day.
We hear that value investors sit on a lot of cash if they can't find something to put it in. And we've heard that has happened to you as well. I'm just curious as to what do you do in that kind of situation? How long do you sit on your cash? What do you do with it?
See, when you cannot find ideas, then the best thing is to stay in cash. And when you stay in cash, you sometimes can have problems in terms of getting restless, and you feel kind of as if you don't know what you're doing. But that is where discipline comes in. If you look at it, last 2 or 3 years, a lot of mutual funds that had cash got into trouble because they were stretching for yield. In the case of the Chou funds, I just sat on T-bills waiting for opportunities. So staying in cash is important until you find something that meets your investment criteria.
And now I've got a couple more questions, and then our last question. Samir.
So, in terms of on a more quantitative basis, when you're evaluating stocks, besides free cash flows, do you look at growth at all, and what are some other factors you look at in your evaluation process?
What you do in value investing is sometimes you look, like, important thing is to look in the past what they have done. And then the growth rates and other factors that you take into it is more like a freebie. But you want to make sure that the price that you're paying it really cheap based on what they have done in the past. The future is more like gravy for you. So
when you're buying small cap stock, let's say get a great buy, and generally there's a problem of liquidity of small caps also. Do you keep a target and say, you know what, then I'm going to invest only 1%, like if I buy a share, then not maximum, then 1% of the company stocks I will take. You keep targets like these, or if you get a great buy, you would like to say get 10% stake or 5% stake?
Okay. It's a good question you're asking in terms of allocation. Like, do you buy 5% or do you put 10% into a certain stock? A lot depends on the industry and the stability of cash flow. You cannot concentrate if you don't have sustainability of free cash flow or earnings. So it depends on the company, depends on the industry, and it depends on the stock price. And I would play a basket if the certainty is not high. Like, to concentrate, then I need to have, let's say, certainty of, let's say, 90% or more, and the price has to be very cheap. But your question is a really good one, and it's something that you will find over the years when you're investing, always asking yourself how much more to go.
But you're not an activist investor. You don't buy to force changes, basically, right?
No, we have been over a 27-year history. We have been more or less been passive. We have not been activists.
Just along that line, can you tell us the personality type of value investor? It seems that in terms of a more like hedge fund manager would be more of a type A personality, and the MBA students would be more inclined to try to be the next Kravis or Flowers as opposed to the next Chou. But can you just explain maybe some of that with your personality?
That personality, by the way, it takes a while to find out who you are and how you react to certain situations. And early on, it's harder to define. But the more you are in the market, the more you'll find it easier to define yourself. Like, when I started investing, I was more, because I was new to investing, I kind of had more stocks, more diversification. But as my knowledge grew and my confidence grew, I started to concentrate more. But concentration versus diversification has another part, and that is, are you finding bargains in troubled industries? If you're finding in troubled industries, you diversify. Are you finding bargains in good companies? Then you concentrate. So that's another part of the equation. So it's, you cannot just answer it, just using one criteria.
Okay, a couple of last questions, then we'll finish. Now, how do you feel about universities teaching value investing? Do you need a special talent to be a value investor, or anybody can learn it?
I think anyone can learn it. If you're good shoppers, you just need good accounting knowledge. That's the language. And if you know it, you just have to apply it and believe in it. Believe that eventually that logic prevails. And when you buy them cheap and you know logic prevails, that gives you the confidence. But don't get sidetracked by short-term performance and other negative factors that person may bring in. Logic prevails in the long run.
Okay, the last question, I guess, is what is the biggest thing you learned in investing through all these 25 years of experience?
For example, I would definitely put integrity on top of the list. Then there are other factors. Then, for example, like avoiding potholes. That is really important in investing. A lot of times, your good returns comes in. It's not because of the great stocks you buy, but because you avoided potential potholes. And then the third one is, to have the courage of your work, courage of your valuation, and go with it. And if you're right, the market will prove that you're right eventually. But short term, don't get dissuaded by that.